How to adjust an iron condor with low liquidity. Are you facing challenges with your iron condor strategy due to low liquidity? You're not alone. Many traders find themselves in this situation, and knowing how to adjust can make a big difference. An iron condor is a popular options strategy that involves selling an out-of-the-money call spread and an out-of-the-money put spread at the same time. This strategy is designed to profit from low volatility in the underlying stock. However, when liquidity is low, adjustments become trickier. First, let's talk about what low liquidity means. It refers to a situation where there is less trading volume in the options contracts, which leads to wider bid-ask spreads. This can make it more expensive to enter or exit positions. You might find that the price you get is not what you expected, which is known as slippage. This can complicate rolling or closing legs of your iron condor since there may not be enough counterparties willing to trade. One effective approach is to use partial adjustments instead of rolling the entire spread. If the underlying stock moves toward one side of your iron condor, consider adjusting only that side. For instance, if the stock price rises near the short call strike, roll just the call spread higher while keeping the put spread intact. This method reduces the number of contracts you trade and can help lower costs. Another strategy is to widen the strike distances when making adjustments. By selecting strikes that are further out of the money, you can reduce risk and increase the chances of success. This approach may also improve liquidity slightly, as more traders might be interested in those strikes. If you decide to roll, consider extending the expiration date. This can allow you to collect more premium and give the underlying stock more time to move back into a favorable range. However, be sure to check the volume and open interest of the longer-dated options, as they may have different liquidity profiles. It is also wise to avoid making frequent adjustments. Since low liquidity can increase transaction costs, it is better to wait for significant market moves or changes in volatility before making adjustments. This way, you can minimize commissions and slippage. In some cases, if the underlying stock moves strongly against one side and liquidity is too low to roll effectively, it may be best to close that side. This helps limit losses while allowing you to manage the other side separately. Always use limit orders instead of market orders when adjusting your positions. This gives you more control over your entry and exit prices. Keep a close eye on bid-ask spreads and be patient to secure fills at acceptable prices. Lastly, if liquidity is extremely poor, it might be more practical to close the entire iron condor and consider alternative strategies or wait for better market conditions. Adjusting an iron condor in low liquidity environments requires a cautious approach. Focus on minimizing transaction costs and slippage while managing risk effectively. By using partial adjustments, widening strikes, extending expirations, and placing careful orders, you can navigate these challenging conditions more successfully.